Welcome to Mastering Risk Management in Finance, your comprehensive guide to understanding and implementing effective risk management strategies in finance. Risk management is a critical component in financial decision-making. It involves identifying, assessing, and prioritizing risks followed by coordinated efforts to minimize, monitor, and control the probability or impact of unfortunate events. To begin, let's look at the two primary types of risks: systematic and unsystematic risk. Systematic risk affects the entire market and cannot be eliminated through diversification. Examples include interest rate changes, inflation, recessions, and wars. On the other hand, unsystematic risk is specific to a single company or industry and can be reduced through diversification. Here's a practical example. Suppose you invest solely in the airline industry. If the industry suffers due to increased fuel prices, your entire investment portfolio could suffer. However, if you diversify your investments across different sectors, the impact of high fuel prices on your portfolio can be mitigated. Now, let's dive deeper into quantitative risk assessment. This involves the use of statistical models and historical data to estimate the potential losses in an investment. Common metrics include value at risk (VaR), conditional value at risk (CVAR), and beta coefficient. Value at risk (VaR) measures the potential loss in value of a portfolio over a defined period for a given confidence interval. For instance, if a portfolio has a daily VaR of $1 million at a 95% confidence level, there's a 5% chance the portfolio will lose more than $1 million in a day. Conditional value at risk (CVAR) goes a step further by estimating the average loss of the portfolio beyond the VaR threshold. It provides a clearer picture of tail risk, or the risk of rare but extreme losses. Estimating systematic risk often involves the use of the beta coefficient, which measures a stock's volatility relative to the market. A beta greater than 1 indicates that the stock is more volatile than the market, while a beta less than 1 indicates that it is less volatile. Risk management also requires qualitative analysis. Unlike quantitative methods, qualitative risk assessment is less about statistical models and more about understanding the broader context, including regulatory changes, market sentiment, and geopolitical events. For example, a company may assess the risk of entering a new market by looking at political stability, economic policies, and cultural differences. These factors can significantly impact the feasibility and success of the business venture. Let's explore some common risk management strategies. These include risk avoidance, risk reduction, risk sharing, and risk retention. Each strategy offers a different approach to managing risk, depending on an organization's risk appetite and specific circumstances. Risk avoidance involves eliminating activities that expose you to risk. For example, a company may decide not to enter a volatile market to avoid potential losses. Risk reduction involves taking steps to minimize the potential impact of risks. This can include implementing safety protocols, diversifying investments, or using hedging strategies to mitigate market volatility. Risk sharing involves transferring a portion of risk to another party. This is often seen in insurance contracts or partnerships where risk is distributed among multiple stakeholders. Risk retention involves accepting the potential loss from risk and budgeting for it. This is common when the cost of mitigating the risk outweighs the potential impact. Finally, it's important to regularly monitor and review your risk management strategies. Risk is dynamic, and what works today may not be effective tomorrow. Regularly revisiting your strategies ensures they remain aligned with your risk appetite and market conditions. We hope this guide has provided you with valuable insights into effective risk management in finance. Remember, understanding and managing risk is crucial to achieving your financial goals.